Welcome to Dollars and Cents with Freedman Financial, the home for financial advice in a language you can understand. Created by Marc Freedman of Freedman Financial, he and his team of certified financial planner professionals will discuss timely topics that help individuals and families make smart financial decisions. And now, get ready for this week's edition of Dollars and Cents with Freedman Financial.
Welcome back to another edition of Dollars and Cents with Freedman Financial. My name is Marc Freedman.
And I'm Marion Gilman.
And we're here to provide you with some financial advice in a language you can understand. And if you like this podcast, we'd encourage you to like and subscribe to this and all of the other ways that you can find us on any of the social media outlets, any of the podcasting opportunities. And
YouTube, right?
Right, YouTube,
Yep.
Apple Music, podcasts, all that stuff. You can find us. We'd love to have you like and subscribe. Well, I'm back from vacation. You're back from vacation.
Yeah, it's been an exciting week.
Yeah, and it is cold here in Massachusetts.
It is very cold here.
Yeah.
Well, today, actually, it's warm because it's
only
warmer
20.
than yesterday. It's 20. Well, yesterday morning, it was like 5 degrees, which
Crazy.
is, yikes.
So where'd you go on
Crazy.
vacation?
So we went to London. We had such a fabulous time. It was really fun.
Was it cold there?
It was cool, yeah. I mean, relative to here, it was warm, 35 to 40 degrees, but it was cool. But you know what, we had planned on doing mostly inside stuff, so it wasn't as if we anticipated anything other than that kind of weather.
Yeah. And you were gone during the presidential election, weren't you?
The inauguration.
Inauguration, I'm
correct,
sorry, the
correct,
inauguration.
yeah, I missed it all. For better or worse, I just missed it.
Did anything happen in London that gave you the indication that an inauguration was going on while you were there?
No, although there were protests. There was some
Protests?
Protests in London, yes. There were protests against everything. So there was this one protest that was going on, very well contained, very, structured. But the people, we couldn't figure out what they were protesting. Well, they were protesting everything. There were people that were protesting Trump. There were people that were pro-Israeli. There were people against the Israelis. They're pro-Hamas. They wanted more rights for women. So all these different signs in this one protest. It was really a fascinating
I always
sight.
wonder how effective protests really are.
I have no idea. But they were like literally all just contained in this one little line going around the streets and, didn't hinder traffic that much. So I'm not sure how much attention they grabbed.
I guess if it's peaceful, you can say what you want. It's a free country. I think it's still a free country in London, too. So, freedom of speech is allowed, right?
That is true.
Yeah. I went to visit clients this past week. I was down in Florida.
You were actually working.
I was working, yeah. I was down
I was not.
in Florida, visited clients, happened to go to Disney World because Laura's dance school, the North Andover School of Dance, was performing there. They got to perform on the stage in downtown Disney.
And
So
how
we
was
saw
the
that.
weather in Florida?
It was cold there, too. Right, cold all things considered. It was in the 50s. One day it got into the 60s, but it was cold for January. But the one mistake that I made, one mistake of the whole trip.
And what was that?
I needed to get a haircut. And I was desperate. And I generally go to the same people to get my hair cut, and I just wanted something quick, so I pulled into Supercuts.
You know something? I noticed you had a slightly different haircut this
Yeah.
morning, but I didn't say anything. I'm thinking, maybe it's just me.
No, it was. I was
maybe you
kind of,
had a bad night.
Yeah, no, I went to Supercuts, and the first thing the woman says to me is, "What number blade do you use when you cut your hair?" I go,
Oops.
Number blade? I don't know. The barber just cuts my hair with scissors and stuff. So it's a little
there you
tight.
go.
You can all the gray lines and all that. Whatever.
Yeah, well,
Doesn't matter.
Happens to the best of us.
So here we are at the beginning of 2025. And we have a new president in office. Like him or not, he's the president for the next 4 years.
That's right.
The market has responded quite favorably following the election. Following the inauguration.
Right. And in reality, we keep being reminded, and we will remind you, that it doesn't, the president, who the president is, which party he's from, or hopefully someday she is from, makes no difference to the stock market. Stock market doesn't care.
And, the stock market can be a leading indicator on the short term. But
Correct.
when we're investing in the stock market, we're not looking to see how much money can I make in the next 3, 6, 9 months, or even 2 to 3 years. This is a long-term investment strategy when we look to investments for our clients, because we have to tie that into their overall financial planning experience.
That's right. And what are your cash flow needs? And most of our clients, 65% of our clients, live off of the money that they have invested. In other words, they are no longer working for income. They rely on their portfolios to generate income. So in that case, we're looking at it. People live in retirement 20, 30 years. So we need to keep that in mind as we're creating a portfolio. We've got to keep up with inflation. We also need to generate the income needed.
But what you hear, of course, on the news is talks about the economy, the inflation, interest rates, what sectors of the market are going to do better and worse, and what's likely to come. And the answer is, honestly, nobody knows. But there's plenty of prognosticators, plenty of economists who have an opinion.
And you don't want to jump in and out of these, oh, this is a great sector for right now.
Absolutely not.
Really hard to get in.
And so one of the things that we do once a quarter is we get invited to this luncheon that we go to regularly.
Absolutely.
And in fact, we're here doing this presentation
right after it.
20 minutes following the luncheon that we just got back from.
So it's still fresh in our mind, so we can convey the information.
And it allows us also to provide our quarterly webinar that we offer to our clients and any of our subscribers to our newsletter to join us. And that would have run on today, this Thursday, when we're taping this.
Correct.
You're likely to see this a week later, this presentation. But we thought we'd share some of the insights that we collected from our meeting with JP Morgan, who provides us with this thing called the Guide to the Markets. And the Guide to the Markets is something that is made available to you as a consumer. If you went to jpmorgan.com, you can pull up a consumer version of the Guide to the Markets, which is quite nice, and you can take a look at whatever charts you want. But
it's a lot of information.
It is a lot. And you got to find out what details work. And so Pete Isberg, who's our representative from JP Morgan, really hones it down to some really important facts and information that we can share with you. So one of the things that I thought was really interesting, Marion, is last year, as we look at what the market did, the S&P 500 did around 25% last year.
Yeah, which is really spectacular.
But what's really interesting, I thought, was over the past 2 years, it's averaged better than 20% over the past 2 years.
That's right. Exactly.
And 2 years over 20%. But what was interesting is oftentimes people will look at the growth side of investments. There's growth and there's value. We always talk about that.
That's right. And the S&P 500 is half growth, half value. So it's 50-50. That's how it's divided.
So think about the growth side of the large growth stocks. That's 250. But there's an index that's called the Russell 1000 Growth.
Correct.
And that's 1,000 growth
of the
stocks.
Largest growth stocks.
And we oftentimes use that index as part of a portfolio for some of our clients.
Correct.
However, one of the things that's interesting to know is 50% of the performance of the Russell 1000 Growth Index came from 5 stocks last year.
It's amazing. And I mean, that's a significant amount of the index. Remember, 1,000 stocks, only 5 of them created the bulk of the performance of this index.
5 out of 1,000.
And you can guess which stocks
I think they were, in fact, he mentioned them to me. NVIDIA, which was up 171% last year.
Wild.
Google up, I think I'm reading this right, 35%. Apple up 30%. Meta, which is Facebook, up 66%. And Tesla up 34%. It's pretty wild.
Yes.
And this has happened now 2 years in a row.
That large growth has been the bulk of the performance. A certain number of stocks. I think last year was more like 7 stocks.
7 stocks. It included
last year.
Amazon and Microsoft were
Correct.
included the year before.
And this year it was 5 stocks that represents the bulk of the growth of the index, which is amazing.
It is, but that doesn't stop people from calling us and saying, hey, I think I want to buy NVIDIA. I think I want to buy these stocks. And you know, if you're a client of our office, buying individual stocks is not something that we recommend to our clients.
Absolutely not.
And what we oftentimes don't realize is some of the volatility, the wild volatility that can happen when you buy an individual stock.
Because remember, when you're talking about a stock that has grown 150% or whatever that might be over the course of the year, in reality, I mean, that can pull back 50% and it still has only lost 1/3 of the growth experienced. So you can see radical swings in these stocks.
Absolutely, and it's not uncommon for the more you hear about a stock or some type of an investment, whether it's in your social media feed, whether it's what you hear on TV, what you hear about from friends, I made so much money in this or that, that's when you want to buy. Absolute worst time to buy.
Absolutely.
And
because remember, and also, don't forget, I mean, all these people that tell you, oh, I made all this money, they don't tell you about those stocks they lost money in.
Absolutely.
So you need to be careful.
So remember, when we're looking to build a portfolio, and oftentimes our clients are looking for something that's a 60-40 stock to bond mix, our goal is over time to try to achieve 6 to 8%. That's a goal that we try to achieve. With stock, look, just the growth performance last year, the growth stocks, the large cap growth index, was up 33.4% last year. And the bulk of it was attributed to these 5 or 6 stocks, right?
Right. But honestly, I think the more amazing statistic that he gave us was that over a 2-year time frame, the large growth stocks were up 90%.
90%.
90% in 2 years, driven by 5 to 7 stocks, which is just outrageous. And so, we've never seen that before.
Right. And so the stocks that no one's talking about, the value side, the side where people say, I'd love to get some dividend income, because you're not going to find much in the way of dividend income from high-performing growth stocks. We always want to have some value investments in our portfolio. Last year, the large cap value index in the S&P 500, according to the JP Morgan Asset Management Report, was up 14.4%. And over the 2 years. No, over the 2 years, it was up 27%.
So that's a vast difference. There has never been a time frame where growth stocks have outperformed in that magnitude over any period of time.
And so the likelihood of us reverting back to the norm, though no one knows whether that will happen, the likelihood suggests that might happen because historically it has. But I mean, of course, who knows? So that's why when we're building portfolios for our clients, we want you to have exposure both growth, value, large, small. Like for instance, we oftentimes include international securities in our portfolio. And on the international side, international stocks have not done poorly. They've been in the teens. What's wrong with the teens? If you could get teens returns...
Well, here's the problem.
But no one wants to talk about it, right?
You know what's wrong with that?
What's wrong with that?
What's wrong with that is that U.S. stocks have outperformed for many years now.
Right.
And so although teens are great, U.S. stocks are doing better. So everybody thinks, well, I don't need international anymore. I think that's very short-sighted. We forget that there are a lot of very good companies that happen to be based overseas.
So one of the pieces that Pete had given to us was, if you eliminated the 7 stocks that have really carried the S&P 500, those 7 stocks, if you eliminated them, so now you look at the next 493 stocks, that performance last year would have been 11%. And guess what? The index, the EFA index, was up 11.8% last year. And the emerging markets were up 13.7%.
So when you think about it, they actually outperformed if we didn't have those large technology companies in the index. That's correct.
But we did.
Yeah.
It shows that the United States is a leader, certainly in technology, in AI. But do you think competitors will come around and try to overtake them? I mean,
absolutely.
It happens in every sector, in every industry.
That's
so, you know, when we're building portfolios and when we think about what's to come, I'm still comfortable, and I think you are too, Marion, with maintaining the asset allocation that we continue to build for our clients.
That's correct. And I mean, it's still an asset allocation that we do a lot of research looking at a variety of different analysts, different companies, et cetera, as to what they're recommending and what their outlook is. We distill all that information, and it's still, we remain in that range of what the consensus is. And we need to be there because you want to be able to take advantage when the market goes up as well.
Yeah. And what about bonds? We had talked last year, we said, this is going to be the year where bond interest rates are going to drop.
Yeah.
Bonds are going to finally make a return.
And there were times during the course of the year where we saw that happen. Unfortunately, towards the end of the year, interest rates went back up. So we didn't end the year with much. We did end the year with a positive return on bonds. We didn't end the year with as spectacular returns on bonds as we might have expected. This year, we do expect a couple of rate cuts from the Federal Reserve. The Federal Reserve controls interest rates. They have said, they've pretty much announced that they're likely to lower interest rates 2 times this year. So the expectation is they will do that. However, this year, it's likely that your return on bonds will be primarily from the interest paid on those bonds. Now, remember, interest rates are high, so the interest paid on those bonds is not insignificant. Depending upon what area of the market you're in, if you're in the Treasury market, the interest rates on the Treasury bonds, if you're looking at a slightly longer term bond, you're looking at about 4.5% on a 10-year Treasury. If you go into a more eclectic bond market where you're taking a little bit more risk, you can get much higher interest rates as well. So it's likely that you're going to end the year not with much return from a growth standpoint, growth in price standpoint, but you will get those interest rates on the bonds.
And that's what we believe today. Things can change. Lots of things can change.
That's correct.
Look, Trump was speaking today to Davos. He was
at Davos,
at
yeah,
Davos, and he
Switzerland.
was virtually going in, and he made a statement today that he wants to push the Federal Reserve to lower rates. Now, the Federal Reserve can do what they want, and he can be as influential. They're independent, but there's a desire to lower interest rates. According to J.P. Morgan, they seem to think it's going to happen twice. And when we say lower interest rates, we're talking about quarter-point reductions in rates. So what that means to you, if you're an investor in the bank, you have savings accounts or CDs or money market accounts, chances are you're not likely to see all that much variability in the interest rate that you're getting now through this year. So,
well, you might see a reduction at some point.
A small one.
But a small one.
But so if we knew that rates, and we don't know this, but if we feel that rates might drop, let's say 0.5 point over the course of the year, you might say, okay, I'm willing to live with that in my money market account, but if my CD is coming due right now and I could renew it for another year, perhaps you can lock in that rate knowing a year from now it could renew at a lesser number. So, we've got to look at the big picture when it comes to interest rates, when it comes to equities, when it comes to everything in your financial situation.
Right. And you do want to remember that although bonds don't see the type of returns that stocks do, you still want that balance, because what if you needed money? I mean, bonds don't have the volatility that stocks do either. So they provide some sort of a buffer to the volatility. No matter how, bonds can be volatile, but they never typically reach the extent of the volatility in the stock market.
And with 65% of our clients needing to draw from their portfolios,
correct,
we keep a percentage of our money in a money market fund, so that you can have flexibility to draw money on a monthly basis, or, hey, I need $50,000 to buy a car.
Right.
We have that flexibility to grab funds, right?
Which is also the reason why we tell people that you want to have an emergency fund. You want money at the bank. You should always have money that is safe and secure. Even though you feel like, oh my God, I'm giving up return on stocks. What if you need a new car? What if your boiler breaks? You need money to cover those emergencies.
So with the beginning of the year in front of us, and 2025, to wonder what will happen, we remain optimistic. If now's the time for you to get serious about your financial planning and investment management needs, we're here to talk to you. We are taking on new clients, absolutely. You can learn more about us on the web. Our website is freedmanfinancial.com. That's Freedman.
2 E's and a D.
Financial.com. You can go to the bottom of any page.
I think he forgot his own name there.
Yeah, I almost for a minute. You can go to the bottom of any page and sign up for our free weekly newsletter that comes out every Friday at 10:30. All you do is put in your name and your email address. But if you'd like to learn more about the firm, schedule time to visit with us in the office or via Zoom, whatever works best for you, we'd be delighted to talk with you. Or, frankly, the phone works too. 978-531-8108. That's 978-531-8108. Feel free to pick up the phone, call us, learn more about the firm. We'd be happy to talk with you And of course, a reminder once again to like and subscribe to this podcast. You can go back almost 13 years to all of the podcasts.
Wow.
Though some of these are video. We used to have a radio show for almost 12 years. Yeah. So you can listen to all the old radio shows, and you can see how accurate we were with some of our predictions years back. We've actually been pretty good most of the time because we're not taking speculative or short-term assessments.
No, we're not.
We're looking far long-term, and I think when you do that, you can be a bit more strategic, a bit more educated, and a bit more thoughtful in the way you take that approach. But that's going to do it for us today. We'll be back again next week with more financial advice in a language you can understand. That'll do it for us today. Have a great day, everybody. We'll see you later.
Bye-bye.
Bye-bye.
During today's episode of Dollars and Cents with Freedman Financial, your host may have discussed specific financial planning and investment ideas that are for general information only and not intended to provide specific advice or recommendations. Please remember that investing involves risk and may include loss of principal. Always consult a certified financial planner professional, qualified attorney, or tax advisor prior to investing to determine what is appropriate for you. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA, SIPC.